Today, folks, there has been a lot of criticism, concerns, and questions surrounding the lack of performance of the Schwab US Dividend Equity ETF. An ETF I hold close to my heart and my soul as a dividend lover, and as somebody who believes that the real value that currently exists within the market is mostly within some of these large dividend payers. I kind of take it to heart when people start criticizing it immensely, considering I have a massive investment here. I mean, we're talking about an investment of $45,000 and one that I continue to add onto, and we're going to break down this ETF's components, the current returns, what I suspect some of the future returns could be. And if that is a conversation you'd appreciate, hit that like button, because first and foremost, the Schwab US Dividend Equity ETF has only been under fire as of this year because it's trading down 8% and comparable to VOO that is up a whopping 15%. But we all know VOO and the S&P 500's performance has come from the Magnificent Seven, these tech companies that have proven quite resilient as their revenue numbers start to rebound and lift the entire indice. It's also why I have most of my money sitting in the S&P 500 and not SCHD, but that doesn't mean I think SCHD should just be wiped off and I should sell it, because I do think a lot of these tech companies are getting very expensive, and inevitably the lower half of the S&P, where the real value currently resides, is going to have to rise at some point into the future. If we take a look at the kind of returns and comparable here, like I said, you could have gone through many times in history where SCHD was outperforming the S&P 500, which was quite impressive, but only as of this year do we see some kind of deviation between the two, right? And taking a look, if you invested 10,000 SCHD from 10 years ago, today you'd be sitting on $25,000, $26,000, whereas comparable, if you put it in the S&P 500, you'd be sitting on around $28,000, $29,000. But again, that's only as of this year. If we take a look at the variable returns based on annual compounded return, it's very intriguing because, again, these metrics change quite variably, but taking a look over the 10-year right now for SCHD, you're looking at about 10%, but considering the SCHD has been around for about 12 years, the actual rate of return is around 11.77% since inception. And obviously, if you take inflation into consideration, you're looking at about 8.88% or 7% over the last 10-year period. And comparable to VOO, I mean, the max 153-year return, which I think is funny because I don't think there's 153 years of VOO. There may be in the S&P 500. I'm not too sure, but they're saying it's about 8.8%. And again, after inflation, 6.63. 30 years, it's about 9.5 to 6.8. We do not have that kind of history with SCHD. So we'll kind of keep it on the 10-year comparable, where we've been seeing a return of about 11%. Wipeout inflation is about 8%. And I want to remind you, what kind of return 1% difference can truly make, because I mean, we can see that there's about a 1% variant over the last 10 years. So if you put $100,000 in, with 30 years to grow it at 8%, you very quickly become a millionaire if you can get to that 100K mark and never touch it. But if we can drop that down to 7%, where SCHD currently is after inflation, you can see there's a difference of by almost $250,000 over a 30-year period. That is very extensive and should be concerning, which again is why I state you shouldn't be putting all your money just into one ETF or another. You need to always be broadly diversified to try and get the best performance across the board here. But still, I mean, I don't think in the long run SCHD's performance is going to continue to be this hindered, because it's only based on the macro environment. The expense ratio on the Schwab Dividend Equity ETF is 0.06%, whereas VOO, it's 0.03. So you're talking about a 0.03% difference, literally pennies on the dollars in comparison. But where things get intriguing to me is the 14 price to earnings multiple, which is lower than the historical median of the S&P 500. And again, when we're talking about the dividend income hitting at about 3.92% on the last 30 days, this thing starts becoming very, very attractive very quickly. And just taking a look at the holdings, and what I find absolutely most intriguing is stocks that I've looked at personally that I'm like, I could buy this right now, vastly spread across some of the top holdings in this ETF. Now, the best performer that sits at the top, no surprise, is basically Broadcom. These chip makers have absolutely been crushing it this year. Broadcom has been on an absolute tear, and it's nice that it does pay a very healthy dividend incomparable to some of the other chip companies. So getting some of that performance while also collecting an income. Second in line, we have a biotechnology company here, biopharmaceutical, that's actually up 2% this year with a 3%, just over 3% dividend. And that taps into being just about a 5% total return for the year. Really not that bad. So the top two holdings, which again, this is fairly equal weight. If I zoom my head out of the way or I zoom up, we can see they're all between 4 and 4.5% roughly. And the performance weightings aren't going to make a huge impact. It's not like VOO where Apple makes up a huge percentage. But as we go down the list here with things like Verizon, I think there's a huge value set up right now in a company like Verizon trading at a multiple total of 7 with over a 7% dividend yield. And it looks like it's picking up some steam here as well. Whether that continues, time will tell. And in line beyond that, you've got companies like Coca-Cola and Pepsi. These are two companies that you could hold as standalone companies in your portfolio, just as Warren Buffett does, and you would have collected astounding returns over the last decade. Yet the fact is year to date, these things just look like garbage. I mean, Coca-Cola is down almost 10%. So with the current starting 3% dividend yield, people are still going to crap on this because of the current year-to-date performance. But if you zoom out, I mean, there's been astounding returns offered by this company, including the dividend increases. You look at a company like Pepsi, down 6% with also a starting 3% dividend yield. You zoom out, and again, you look at that price performance, and there's very few times in history where this stock has fallen off to such dramatic levels, right? So it sets up what could present as a buying opportunity. And even farther down the list, I do find things like Home Depot also very attractive at these current levels. We're going to see some earnings out of Home Depot, but housing is going to get hit in this environment. But you have to presume that what we're living through right now is a macro event that is not going to last for the rest of your life. It's going to last for maybe 1 to 3 years, and we've already lived through the vast majority of it. We're coming out on the other side of the eye of the storm. We're seeing the end of the interest rate cycle, and these are companies that will eventually benefit from a rebounding economy. And again, year to date, this thing's down 8%, almost a starting 3% dividend yield. Very intriguing, especially when you look over its past history, right? Let's just take a look at a few more in here. I mean, Chevron's in here for you oil lovers. Not the biggest fan of oil, but you got Pfizer that's been absolutely wrecked. Lockheed Martin's been doing very well against these geopolitical events for those of you that are more into the war type stocks. I mean, a lot of cool companies. Altria Group, I'm not the biggest fan of, but again, it's fairly valuable. 3M's been absolutely wrecked. US Bank Corp. Now, in a world where a lot of people think tech companies are incredibly overvalued, this is such a great way to diversify your portfolio. Pick up the lower half of the S&P 500 with companies trading at much better multiples with real potential into the future. And also, if you have to deal with tax liabilities, as everybody says, ooh, we've got to worry about taxes on dividends, it eats into your total return. I don't know if you're buying this in just a regular account, you might want to look into it, but as somebody that owns this in their RRSP, I pay no withholding as a Canadian on the dividends, and I pay no taxes, and I can reinvest this and get the full compounded rate of return until I decide to draw against it, at which, as I plan on retiring early and not later into my actual retirement into 60s, I'm going to be drawing against this account much earlier, and I don't want to have to sell these stocks if I don't have to. I'd rather just collect the income. So it's kind of like a self-propelled machine where I'm getting a 5% discount off my current average cost, and I can just reinvest at these discounted levels until the market starts to see it as a potential buying opportunity once the economy kind of flips back. But that's just my personal opinion here. I love SCHD, and I think the criticism is too short-sighted. And if total return really matters to you, which I believe it does, I think you're going to look for value in the market. And if you can do it tax efficiently, this is where the value lies. But it's just my opinion. What do you guys think in that comment section below?